March 2026, the world faced a black swan event. Brent oil rose from $78 to $119 per barrel. Gold shattered records exceeding $5,300 per ounce. Then the war began. Gold fell 11.5%, resting at $4,650 by month's end. Bitcoin started at $67,356, peaked at $74,486, and closed at $68,234. The Strait of Hormuz was under threat. Headlines screamed, Iran, Israel, missiles and US intervention. But what the headlines did not say was perhaps more worth reading. Small investors ran to gold as prices peaked. At that exact moment, the world's largest hedge funds were opening short positions at $5,200. They were betting on a fall. Meanwhile, Goldman Sachs was restructuring petrodollar flows in the Gulf toward AI investments. JP Morgan's CEO Jamie Dimon was in Singapore and Shanghai. He was building alternative capital channels. Larry Fink, CEO of BlackRock, was in Ankara. The European Union announced a €30 billion emergency energy transition package. An old Arabic saying exists: when the wind blows, some build walls, others build windmills. The Big Short shows this brilliantly. Some people look at the frame, but others see behind the frame. They live this proverb. This saying summarizes what we saw well. Before we discuss oil prices and conflict zones, let me step back. Because the foundation of this story lies not in stock exchanges, it lies in the human brain. What happens in your body when you hear an unexpected loud noise? Deep in your brain is a small structure called the amygdala. It activates instantly. Cortisol is released, your heart rate rises, your muscles tense, blood flows from your digestive system to your limbs. This is the fight-or-flight response. It evolved over millions of years to keep you alive. And here is the critical detail. This response begins before your rational brain evaluates the threat. You react first, you think later. Markets are not algorithms, markets are not graphs, markets are millions of interconnected human brains. And when a threat appears, a war, a missile strike, a geopolitical crisis, what happens? Inside Out illustrates this perfectly. If fear takes over the control panel in Riley's mind, all other emotions are sidelined. The same happens in markets. Millions of amygdalas fire at once. Markets do not think, they react. They do not analyze, they fear. Billions explains this perfectly. If everyone gets the same information at the same time, it's no longer information. It's noise. The advantage goes to those who access information early. This fear has a pattern. Every single time three things happen. Oil rises, gold rises, stocks fall. But there is a fourth movement, silent, invisible, rarely discussed. Large institutional players take positions, every time, within hours, not because of the war itself, because of the price distortions created by uncertainty. The Romans had a phrase for this. The exact translation is lost, but the meaning survives. Inter arma animis silent leges. When arms speak, laws fall silent. Applied to markets. When fear speaks, reason falls silent. And someone's reason continues working. In that silence, let us look at the evidence. October 1973. Egypt and Syria launched a surprise attack on Israel on Yom Kippur. In response to US weapons support to Israel, Arab oil producers declared an embargo. Oil prices rose from $3 to $12 per barrel in months, a four-fold increase. The Dow Jones fell 45% over the next year. Inflation hit double digits. Now compare this to 2026. In 1973, the weapon was an oil embargo. In 2026, the threat was the Strait of Hormuz. Different decades, same choke point. 20% of the world's oil, approximately 21 million barrels per day, passes through that narrow waterway. In 1973, prices rose 300%. In 2026, prices rose 42%. The numbers differ, but the underlying structure is familiar. And there was a detail in 1973 that most people did not notice at the time. The embargo was a surprise to the public, but it was not a surprise to the major market players. Margin call shows this dramatically. You make money three ways. You be first, you be smarter, or you cheat. Large players chose to be first. Positions were being built weeks earlier. A Chinese proverb says, "The wise man builds the bridge before he sees the water." This phrase describes the major investors of 1973. It also describes the major investors of 2026. The Shah of Iran fell. Iran's oil production dropped from 6 million barrels per day to nearly zero. Oil prices doubled again. Gas lines stretched for miles across America. The economy entered a dark period called stagflation, high inflation combined with slow growth. The worst scenario for economists. Note this word, stagflation, because in 2026, central banks, especially the Federal Reserve and the European Central Bank, delayed interest rate cuts. Why? Because rising energy costs threatened to reignite inflation. The shadow of 1979 was long. Gold rose from $200 to $800 per ounce in 1979. In 2026, gold rose from $4,400 to $5,400, but unlike 1979, this time came a rapid retreat. Gold saw $5,400. Then, just weeks later, it fell to $4,450, an 18% loss. Many small investors bought at the peak. Large hedge funds had opened short positions at the peak. In 1979, this was called information asymmetry. In 2026, the discussion centers on the word manipulation. The name may have changed, but the structure is familiar. A Persian saying exists: the one who stands before the baker knows what will be taken, but the one who sets the price knows what will be sold. The question of who sets the price is valid in every era. August 1990. Saddam Hussein invaded Kuwait, overnight controlling a significant portion of world oil reserves. Oil rose from $17 to $35 per barrel in 3 months. Markets fell sharply. Gold rose. But what many people missed was this. When the war's outcome became predictable, when uncertainty decreased, markets began to recover within months. And during this recovery period, large funds moved silently. They gathered falling oil stocks. They accumulated market indices. Assets abandoned in panic passed into the portfolios of those who waited. The war was not over, but uncertainty had decreased. For markets, that was enough. Looking at 2026, a similar picture emerges. Wall Street shows this well. The point is, ladies and gentlemen, that greed is good. Greed is right, but when most panic and sell, large players quietly accumulate. This philosophy works. Larry Fink meeting with the president in the midst of war. Goldman Sachs building Gulf petrodollar channels. JP Morgan restructuring in Asia Pacific. These actions suggest not preparation from chaos. They suggest preparation for what comes after chaos. A Turkish saying explains this well. Stack firewood before winter comes. Large players were gathering firewood while most people watched the storm. In 1990, the Carlyle Group played this game. In 2003, Halliburton played it. In 2026, the names changed. The structure did not. September 11th, 2001. The world woke to a different place. Markets closed for 4 days. When they reopened, the Dow fell 14% in a single week. The worst week since the Great Depression. But look carefully at what followed. Within 2 months, markets had largely recovered. Not because the threat disappeared, the Afghanistan operation had just begun, but because the initial shock was absorbed. Biologically, here is what happened. The amygdala fired. Then the prefrontal cortex, the rational decision center, took over. The brain said, "We know this threat now. We can measure it." And during those 2 months of decline, defense industry stocks, Lockheed Martin, Raytheon, Northrop Grumman, gained 40% to 60%. A Japanese saying teaches, "Look at the seedling growing among the ruins. One person's catastrophe became another's soil." The Dark Knight illustrates this perfectly. Some watch the fire, but others start buying the land while it burns. It is harsh, but it is a repeating truth. Markets fear what they cannot measure. When fear becomes measurable, someone begins pricing that measurement. March 2003. The United States entered Iraq, and something unexpected happened. Markets rose. Why? Because the invasion had been openly discussed for months. When it occurred, uncertainty was already priced into the markets. There is an old saying on Wall Street, "Buy the rumor, sell the news." 2003 was a textbook example. After the invasion began, oil fell, gold fell, stocks rose. The war was worse, but uncertainty was less. Markets care about only one of these things. 2026 showed similar signals. Information about the operation's scope and the possibility of diplomatic retreat reportedly reached certain circles early. If true, gold falling from $5,200 to $4,600 is not coincidence. It is early information holders closing short positions. In 2003, those with early access to information profited greatly from the Iraq War. In 2026, those with early access profited from the gold market. 23 years passed, the tools changed. The structure remained. February 2022, Russia invaded Ukraine. Oil exceeded $130 per barrel. European gas prices hit records. Gold rose, markets fell globally. And again, within months, markets adapted. Supply chains reorganized, new energy sources came online. Uncertainty was absorbed. But something else happened in 2022. As gold rose, Bitcoin initially fell, sold as a risky asset. Then a shift began. Institutional investors started viewing Bitcoin differently. In 2026, this shift is maturing. Bitcoin fell to $66, then returned to $68. Gold-backed digital assets, tokens like Pax Gold, became a primary channel for capital, fleeing the slowness and opacity of the physical market. Darwin made an observation, frequently quoted, but its depth is felt each time. It is not the strongest that survive, nor the most intelligent. It is those most responsive to change. In 2022, this was debated. Moneyball emphasizes this well. If you think like the rest of the crowd, you are not going to make any money. Institutional investors saw Bitcoin differently. When most people still thought the old way, 6 walls, 6 oil spikes, 6 gold waves, 6 market shocks, 6 recoveries, plus a silent fourth phase. Each crisis, large institutional players quietly accumulating discounted assets. Phase 1, shock. The amygdala fires, markets become anxious. Oil rises, gold rises, stocks fall, headlines amplify. Small investors either panic sell or panic buy. Phase 2, absorption. The rational brain takes over. Information is gathered. Threats are evaluated. Uncertainty begins to decrease. Phase 3, adaptation. Markets find a new equilibrium. Supply chains adjust. Prices stabilize. Phase 4, consolidation. Succession depicts this grandly: the boardroom, a long table, silent figures at the center of power, a world map on the table, assets as objects of play. This is the setting. Large institutional players, BlackRock, Goldman Sachs, JPMorgan, major hedge funds quietly gather assets that have fallen in value. Strategic positions are built. In 1973, oil companies accumulated positions. In 1990, infrastructure contracts in the Gulf changed hands. In 2001, defense industry stocks were gathered. In 2003, Iraq reconstruction contracts were distributed. In 2022, European energy infrastructure was restructured. In 2026, BlackRock is in Turkey. Goldman Sachs is in the Gulf. JP Morgan is in Asia Pacific. In biology, this process is called allostasis, the body's process of reaching a new balance through change, not returning to the old normal, building a new one. But during allostasis, some cells strengthen and some weaken. The system reaches balance, but not everyone arrives at that balance in the same position. In markets, the same happens. The Godfather teaches this narrative. To think is to pause. To pause is not to fall behind. It is to move forward wisely. Thinking can be more powerful than rushing. The system adapts. But the cost of adaptation usually falls on the same group, the small investor who does not see the pattern, the one who moves by amygdala, the one who cannot read the strategy of large players. An African proverb says, "When the river dries, the fish learns to walk on land." Markets are the same. When old structures lose trust, capital must find new channels. Let's look closer at 2026, January. Gold is stable at $4,400. Late February. Iran's real tensions rise. Anxiety spreads. Early March. Gold hits a black swan peak of $5,300. Huge buying from small investors fearing war. And at that exact moment, at the historic peak, large US-based hedge funds open clear short positions. They bet on a fall. Late March, gold retreats to $4,450. The investor who entered at the peak is now down 18%. The institutional player who opened short at the peak is in profit. Then news arrives, reports that information about the operation's scope and diplomatic retreat possibilities had reached certain circles early. If true, here's what happened. Some people knew how long the crisis would last before the public knew. They acted on that knowledge. This is not a new story. In 1815, Nathan Rothschild knew the outcome of the Battle of Waterloo hours before London did. He knew because of carrier pigeons. He positioned himself in the stock market. The result was enormous profit. In 2026, there are no pigeons. But there are private intelligence firms, companies that sell satellite imagery, government consultants. Information is still power, and access to information is still unequal. 210 years passed. Too big to fail explains this well when the public finds out. The reality is already priced in. Algorithms instead of pigeons, but the principle is the same. Pigeons became algorithms. The structure stayed the same. An old English phrase states, "Knowledge is power." This statement from 1597 has remained valid for over 400 years. Because though the nature of information changes, the advantage of possessing it does not. 2026 shows a development that departs from historical patterns. This requires careful attention. Traditionally, during crises, capital seeks three places: gold, US Treasury bonds, and the Swiss franc. This has been true for a century. But in March 2026, this habit cracked. Allegations of gold market manipulation shook investor confidence in traditional safe havens. A question arose: if even the most trusted haven can be questioned, what is truly safe? Bitcoin fell to $66 initially, sold as a risky asset. But as the scope of gold market speculation became clear, a reverse flow began. Capital moved into digital assets. Bitcoin pushed towards $75,000. Gold-backed digital tokens, such as Pax Gold blockchain-based instruments, backed by physical gold, became a primary channel for capital, fleeing the slowness and opacity of the physical market. The Matrix shows this cinematically. I can show you the door, but you have to walk through it. When trust breaks in the traditional system, capital chooses toward the blockchain door. The slowness and opacity of the physical gold market contrasted with blockchain's transparency and speed. This attracted a portion of capital. There is irony here. Capital fleeing a trust crisis in the traditional financial system is turning toward decentralized finance. In biology, this is called migration. When an ecosystem comes under pressure, organisms seek new habitats. Those that are agile and adaptive move first. In 2026, a portion of capital is migrating from the traditional financial ecosystem toward the digital one. Whether this migration will be permanent or temporary is not yet clear, but the direction is observable. And if the U.S. Securities and Exchange Commission launches a formal investigation into gold market allegations, this process could accelerate. Because such an investigation would mean official recognition of traditional system vulnerabilities. Markets work the same way. When old structures lose trust, capital must find new channels. So what can we extract from all this historical and biological perspective? First, know your own stress response. When you see headlines, red graphs, and war news, your brain is doing exactly what it evolved to do. It prepares you to flee. But fleeing from markets is not the same as fleeing from a predator. In the financial world, emotion reaction is often the most costly reaction. Because while you are selling, someone is buying what you are abandoning. Second, separate the event from the uncertainty. The event may be severe, but your financial decisions should be based not on emotional intensity. They should be based on how long uncertainty lasts and how large it is. Third, do not forget the fourth phase. While everyone is occupied with shock, look at where large institutional players are going. Watch who they meet with. These movements show markets' true direction more accurately than headlines. Fourth, acknowledge information inequality, but do not surrender to it. You may not have access to information that large funds access, but knowing the pattern is the most effective antidote to this inequality. A beautiful mind shows this well. You look at the problem from a different angle, like the person who discovered Nash equilibrium. Those who see markets' balance point from a different angle gain an advantage. Those who recognize the pattern make healthier decisions even if information arrives late. Fifth, question the concept of safe haven. For a century, gold was an unquestioned safe haven. 2026 shows the first serious crack in this assumption. This does not mean gold is finished, but it may mean the definition of safe haven is evolving. And sixth, remember Warren Buffett's frequently quoted statement, "Be fearful when others are greedy. Be greedy when others are fearful." This is not just investment advice. It is actually a one-sentence summary of a natural law that Darwin observed millions of years ago. And I will add one more thing. A Turkish saying teaches, "Patience is bitter. Its fruit is sweet." In markets, patience is as valuable a capital as knowledge itself. Dune teaches this philosophically. Fear is the mind killer. In markets, fear kills reason. Patience keeps reason alive. 6 walls, 6 oil spikes, 6 gold waves, 6 market shocks, and 6 recoveries, plus a silent fourth phase. Each crisis, large institutional players patiently building positions. In 1815, Rothschild carried information by pigeon. In 2026, it is carried by algorithms and private intelligence firms. The tools changed. The structure is identical. This pattern is not prophecy. It is a biological observation. Markets are people. People are biological. And biology has certain regularities. Right now, millions of amygdalas are firing worldwide. Headlines are precisely designed to trigger this response. But if you have reached this point, you possess something many people do not. You have seen the pattern, you have read the history, you have heard the signal. The question now is this: will you respond with your amygdala? Or will you move with a mind that understands the pattern? A Persian proverb says, "This too shall pass. Fear passes, greed passes, understanding remains." If this journey helped you see the signal, please like and share. Your comments are vital for us. They will shape the future of this new channel. Subscribe to support our growth and decode the future together. Hope to see you next journey. Until then, stay calm, stay curious. And remember, there is no noise, only signal.